Today in our commercial real estate division, it's a great privilege to have with us Phil Atwan from Exchange Resources Incorporated, which operates as one of the largest independent qualified intermediaries in the nation. Thank you for being here today, Phil.
You're welcome, Mandy. It's a pleasure to be here.
Nice to see you. Could you tell our internet audience about what services your firm performs and how and why these services are of great benefit to any current or potential investor?
Mandy, that's a really good question. Our services are basically what the IRS calls as qualified intermediary. On the street, we call that accommodator. And basically what that allows us to do is to facilitate a 1031 tax-deferred exchange on behalf of an investor who wants to sell, defer their taxes, and to acquire other investment real estate.
Let's give our audience a little overview. Can you tell us exactly what a 1031 exchange is?
1031 exchange is simply sort of what we just discussed. One of the items of a 1031 exchange, which by the way was created in 1921 by Congress, is to allow a real estate investor to sell and defer tax. What tax are they deferring? Well, when you sell an investment property, assuming that you have a capital gain, you will have to pay capital gains taxes. Today, the long-term capital gains tax rate is 15%. That's only good until the end of the year. From what we're hearing, and we've had a lot of discussion on this, depending on who wins the presidential election and depending what Congress will look like, could alter that 15% rate to a higher bracket. So we'll just have to wait and see, but that's the first tax that has to be paid. The second tax, Mandy, that has to be paid is called the recapture of depreciation. As an investor, we write off our property. The government allows us to depreciate all the improvements into the property. It's a tremendous tax advantage. It gives us a tax shelter. But unfortunately, when you sell the property, you have to pay a tax on all the depreciation that the government allowed you to have. And that's a flat tax of 25%. The third tax we pay is to the state of California, also known as the Franchise Tax Board. The Franchise Tax Board wants their cut as well. And currently, it's 9.55%, but as you and I are actually speaking, the governor and his entourage is considering the possibility, the strong possibility, of raising that 9.55 to a much higher number. That's what happens when you sell investment real estate. You have to pay the taxes. The 1031 exchange allows you to keep this money, not to have a tax-free scenario, but a tax-deferred scenario, which allows the investor to take the tax money to put into the acquisition of the new property, being tax-deferred.
What have been the motivating factors for real estate investors to purchase over the past few years?
The motivating factor, Mandy, is to buy at the bottom of the market. We all know that when we sell a property, we're going to sell it for whatever the market will bear. The key is how low we can acquire the property. Where we are in the cycle right now is no one's really 100% sure, but it's somewhere towards the bottom. We could be coming out of it. We could also see another dip, but we're still somewhere towards the bottom, and investors know the time to buy is when you're towards the bottom. The second motivating factor is the interest rates are incredible. Mandy, you and I both know interest rates cannot stay where they are today. It just cannot keep that pace. Eventually, as our economy heats up, inflation will begin to raise its ugly head, and ultimately, interest rates are going to go up. So between the pricing and the interest rates, I just see a tremendous opportunity, and that's why investors are out there swallowing up all the properties they can possibly acquire.
Excellent. Tell me, Phil, what are the 4 basic areas of growth real estate investors are looking for in an investment property?
Number 1, Mandy, beyond a shadow of a doubt, number 1 is the king. It's called cash flow. We buy investment property, so our properties will work for us so we don't have to. We want income, the ability to live off the properties. Number 2, we want to not just get a cash flow, but we want to retain that cash flow by having some kind of tax shelter or tax advantage. In real estate, we We call that depreciation. The federal government will allow us to write off or depreciate any improvements to the property, which is a great tax savings to an investor. Number 3, not only do we want a cash flow, not only do we want to write it off, but we don't want to put all our eggs in one basket. Well, what does that mean? That means over time the value of property goes up. And if something should happen, like rent control, and it sticks its ugly head in another area, or a major disaster like an earthquake, you can lose a lot. The purpose of diversification is the ability to take some of that equity and to distribute it into other areas. So those other areas will not only produce cash flow, but it produces safety for me in my future. Lastly, the motivating factor of investing in real estate, and if you think about this, what other investment can you buy that you can buy without having to pay the full price for it? You can do what? Finance it, so you can leverage it. You can write it off. You can keep adjusting it and diversifying it. And then lastly, you want to watch it go up in value. I can't find another investment that can do all that.
Absolutely. That really is great information, Phil. Now we know and understand that return on investment has been wonderful for those real estate investors that got into the market 12 plus years ago. Is there a method of calculating how hard their property is actually returning each year?
Absolutely. You know, Mandy, something that we do, or we should do, at least on an annualized basis, is go to a doctor. See how the blood is doing. See how the organs are working. And make sure that everything is the way it's supposed to be. Unfortunately, we don't do that as investors with our investment real estate. We were wise enough to make a purchase 12, 15, 20, 25, 30 plus years ago to acquire the property, and we've had a wonderful return on investment. But the problem is, there's a lot of equity that's grown in those properties over the last 12, 15, 20, 25, 30 plus years. Shouldn't that equity be producing income? And what happens is, investors, to determine how hard or how weak their property is working, they need to have a test. And here's the test. And this test they can, by the way, pick up on your website. Absolutely. It's number 1, how much income is the property generating gross on a monthly to annualized basis. Number 2, what does it cost to keep the property maintained with every single cost that you have to put out each year. And by the way, those first and second calculations, your clients are already telling the federal government with this into the by putting down the Schedule E of their tax form that they submit to the federal government each year. So it's already there. Number 3, you have to determine what the net equity is onto the property. You've got the calculations to do so. Lastly, what we do is a simple division equation. And then by doing that, your client can take a look at the property to determine what the rate of return is of all the equity that's sitting in the building. Mandy, you and I both know that equity is virtually nothing but paper. It's worthless unless it produces income. You can do that 3 different ways. You can sell the asset and have the cash. Number 2, you can refinance the asset, take the cash out, but you'll have to pay it back with interest. Or number 3, it has to generate income on a annualized, monthly or annualized basis. So the question is, how hard is that property actually working? This formula can actually help your client, your investor, to determine if they're pleased with that kind of return on the equity that's in their building.
Now, considering the cost of money and current prices, what can a real estate investor do to take advantage of opportunity if it comes knocking?
That's a really good question, Mandy. Here's my answer. The government now allows us to do something called a reverse exchange. In a typical exchange, I would first sell and acquire later, up to 180 days later, as long as I name the address of the property I'm going to buy within 45 days after the sale has closed. as long as you're using an accommodator company like ours. However, under a reverse exchange, let's say you find the perfect property for one of your clients. It's priced incredibly well. It's in an incredible location. And it's one of those properties that if you don't jump on it very quickly, there will be 20 backup offers for it in the next 24 hours. A reverse exchange allows you to acquire that property first because you don't have time to sell and to do an exchange, but it lets you, through a reverse exchange, to acquire first, and lastly, close your sale up to 180 days later.
So Phil, in conclusion, with the current economy in the state it's in, including the tight credit environment indicated by nearly 30% of commercial properties being sold in 2011 being purchased with cash, would you say that now's the time to buy?
Beyond a shadow of a doubt, and I'll tell you why. When you see a great influx of cash to acquire full price, to acquire real investment real estate, it's telling us something, that real estate is now a good commodity to buy. It is great to acquire at the bottom of the market, not at the top of the market. Because those who buy at the top of the market will later be perhaps looking at foreclosure or short sales. The key to investment real estate is to buy towards the bottom. Coupled with the fact we have these unprecedented interest rates, it produces a conclusion of cash flow and opportunity. And frankly, opportunity will only knock for so long. Eventually, opportunity will leave and go somewhere else. And then that time will be gone. And we would have missed it again.
Well, that's certainly a motivating factor. Thank you for being here today, Phil.
My pleasure.
Thank you to our internet audience. We hope to see you sometime
Mandy,
in the future.
It's my pleasure anytime, and I wish your investors happy investing because this is the time to do it.
Thank you, Phil.
Thank you.